fix your stop so that you're taken out of the market for a known loss in case your hypothesis of what the market was going to do is wrong. And the third question which you have touched on is, okay, now that I'm in the trade and I know where I want to get out if I'm wrong, where should I get out if I am right? The quick answer to that, especially when you're starting off, is at 1-to-1. So a symmetric distance between your entry and your stop, you place a target on the other side, and it's a symmetric distance plus a little bit more because typically you want to cover your spread 2 on the cost so that you're not losing spread over a large number of trades. So the quick answer is take 1-to-1. And the reason you want to take 1-to-1 is it's a easier decision to make as a newer trader. It's also the one that's most likely to give you the highest win rate. So, if you consistently take 1-to-1 targets, then on strategies like the trend flow strategy, you should hope to hit somewhere between your 60 to 70% win rate. Now that's again over a large number of trades and over a short number of, obviously you can have any kind of result. And you can take higher targets, but what happens is the further away you push your target, then the lower your win rate's going to be, and then it starts sort of introducing all sorts of decisions along the way as what you should do. Once you get really good at the 1-to-1 target, the next evolution up, if you will, is taking half your profit at 1-to-1 and then letting another half ride higher. Now what happens is that other half can possibly slide backwards and you get stopped out. And then if you get stopped out at your original stop, you made a 0.5% in the win, you lose 0.5% in the loss, and you have a break-even trade, which isn't bad. Break-even trades are much better than losing money, right? So the next refinement after 1-to-1 trading is taking half at 1-to-1 and then trying to see if you can run the remaining portion further out. And that way, if you do succeed in running the remaining portion further out, then you're getting something slightly better than 1-to-1. And if it ends up being a long distance runner and you make like 2-to-1 or 3-to-1 or 4-to-1 in the second half, then your overall risk to reward on that trade could be better. But that kind of sophistication is hard because the trade is open for a longer period of time, different things can happen, and therefore my suggestion is starting off, just go for a simple 1-to-1 for your first 100 trades or so, see what happens there. By then you'll have a much better feel for the strategy you're trading, whether it's these strategies or other strategies, and then you can start introducing refinements on how you want to do trade management. Okay, hopefully that's a quick answer to your question. But trade management, and there's a lot of sophistication with how you can do it, is actually a entire course by itself. Okay, so that's the disclaimer. I'm not going to spend much time on it since you've seen it at least 3 times. The other disclaimer, which you've seen at least 3 times too, but in short, foreign exchange trading is risky. You can lose some or all of the money in your account, so please don't risk any money that you're not in a position to lose. And please consult a qualified professional before investing real money. You know about TWP and OANDA, so I'm going to skip through this and get to today's agenda. So before we do today's agenda, let me just spend a few minutes recapping everything because we're going to put it all together into a recipe today. Right, so in the first session, we took a look at classic trades, which is we showed you examples long and short on the trend flow strategy and the momentum breakout strategy just to show you what the complete picture looks like. And then we spent the next, part of the remainder of the first session and the second and third session looking at the various technical analysis ingredients that we're going to use to put together in the strategies today. And all along the way, we talked about the strategies themselves. It's not like we were holding them back as a big mystery. So you pretty much know what the strategies are today. We're just going to be a little bit more systematic about them in forms of checklists today. Then we talked about thinking in probabilities, which is, just appreciating that no matter how good your analysis is, no matter how good the setup looks, anything can and will happen on any single trade. Your job is to execute flawlessly and hope that over a large number of trades, the edge represented by your strategy will play out in you winning more often than you lose, right? And that demands, of course, that you exercise good risk management, which is don't risk more than 1% of your portfolio in any single trade until you know what you're doing. And even then, like as professional traders like I am and many people I know are, we still don't bet more than 1% of trade. We're not trying to get rich on any one trade. We're trying to get rich by being right over a long, more often than not, over a longer period of time. Then we started talking about the technical analysis ingredients themselves, and start off by saying one of the most important things you need is optimal chart structure, which is nice, smoothly flowing charts without big gaps, without giant candles, without large wicks and tails, without erratic price motion. What we wanted was nice, smoothly flowing chart where the momentum direction was predictable, they were trending nicely, and therefore there was some chance of guessing where that chart was going to go next. And therefore, if there was some predictability about direction, then our problem was narrowed down to finding a good way for us to jump on this trend so we could ride it rather than being immediately thrown off. And that was the discussion on optimal chart structure. We talked about trends, what trends are, uptrends, downtrends, no trends, how to identify when a trend is starting early on, because our prediction was that, I mean, our knowledge is that trends don't go on for terribly long. 3, 4, 5, 6 waves is your typical trend. So the sooner you can identify when a trend is in progress, the greater chance you can join it and ride it for a longer period of time. So uh, then we also talked about starting to develop your checklist, and hopefully you've been doing that since then. So today is just kind of icing on the cake in terms of checklist. We talked about moving average geometry, about how we like to use the 10, 20, 50, and 200 period moving averages, and we focus in especially around the 10 and 20, which we call the zone, the area between the two lines and slightly around them. And with regard to moving average geometry, we were really looking for 3 or 4 things. One, that you had the 4 moving averages in the right order. And remember, because the 200 period is so slow, we often don't have the 200 period in order. That kicks into the right order when trends are more long-lived. But at least you want the 10, 20, and 15 order, which means that the direction of price movement has been established to some extent. And then the second thing we wanted is those moving averages not only in the right order, but fanning out nicely at similar angles with white space between them. And when you had that kind of geometry, the chances are you would also find accompanying good trends. Then we talked a little bit more about the zone and how price tends to accelerate away from the zone when buying or selling starts, and it pulls back into the zone area when it's doing the pullback, of course. And when the pullback happens, uncertainty is creeping in at some point, and therefore volatility dies down, candle length starts contracting, and you typically find when you have small candles in the zone, that's the point in time where there's enough indecision in the market that the overall momentum then pushes the prices in the overall direction of the trend. We talked about support and resistance, which is looking at areas on the chart in the past that have been resistance for price. And like I said, there's many reasons for SR to show up in the charts. And we enumerated those as being, big round, obvious places, basically. Obvious places where people are placing orders at or near a price point. And this could be big round numbers. This could be prior day, week, month highs and lows. This could be pivot points. This could be Fibonacci levels. Sometimes people place things around like, the 100 period moving average or the 200 period moving average. There's lots of reasons why people are placing orders. And sometimes you have no clue why the order is being placed. And as technical traders, the reasons are less important to us. In fact, the reasons are not important to us. If I find a level in the chart has been tested repeatedly, yeah, there might be a reason if I dig hard enough, but I really don't care. If an area has been resistance a lot, especially in the recent past, then there's a more likelihood that it's going to be resistance again, and therefore I want to know about that. And I think in response to one of the questions you guys asked, we raised this point that if you look at the charts, and say you look a year ago, right? And then one of the questions is, okay, how far back do I look? Because many of you reached out to me after the webinar with questions. And one of the questions was, how far back in the charts do I look for support resistance? And that's a great question, because if you look far back enough and you're looking for 2 touches, you'll find thousands of levels, right? And suddenly your chart looks terribly crowded. So the way to do this is start with the daily and the weekly. If you find flat levels on the daily and weekly, more likely than not, they're going to be important now. But if you're looking, the way I do my own scanning is I draw most of my levels on the 240 chart, which is the 4-hour chart, because I find on the 240 chart, if they're significant, they tend to persist. But for example, and I leave my lines on my charts, by the way. So from last year, if I left lines on the chart and now the price is back in that zone and I see a whole bunch of, lines showing up on my chart, I look back to see, okay, what happened last year that caused this to happen. But if, last year, say, a certain price was causing a lot of price action, but off late, price has been moving through that level without much obvious resistance, then I just disregard it, right? So if there was a reason for it to be an issue in the past and that reason is no longer affecting price, I just ignore it. So I'm just looking for the likelihood of its continuing to affect price going forward. And the other last point we made in terms of SR was that if there's multiple reasons accumulating in close proximity, then there's obviously greater chance that orders are going to be placed there, and therefore a greater chance that price is going to be affected. So for example, if there's a big round number that's also a prior week high and low, that's also a pivot to something, there you go. 3 reasons for orders to be placed, more likelihood that price might find resistance there. We looked at candles and just said, in our world, we just like to look at candles as um, bullish, bearish, and indecisive. And that what we're really looking at was the range of the candle, which is distance between the tip of the candle to the base of the candle. And we're not looking at the body, we're including the wicks. So the entire range of the candle and the close. So, and we're really looking at the relationship of the close to the range of the candle. And if it closes towards the top of the range, that's bullish. If it closes towards the bottom of the range, it's bearish. If it closes in the middle of the range, it's indecisive. The open of the candle, which is what contributes to the construction of the body, is more an issue of timing, which is why traditional chartists and indicators like the pivot point, etc., don't really pay much attention to the opening of the candle because that's a function of timing. The closing of the candle is really a kind of periodic representation of what happened to this tug of war battle. What's next? MACD. So then we moved on to looking at MACD and RSI convergence and divergence, which we said we use MACD and RSI in a different way than the literature uses them. We're basically using them to look at convergence and divergence, which is we look at the shape of the price curve and compare that to the shape of the MACD and RSI. And if the price curve is making higher highs in an uptrend, we want MACD and RSI to make higher highs or equal highs. We call that convergence. And if it's a downtrend, obviously we're looking at the lows. So we look at the lows in price in the downtrend and the lows in the MACD and RSI in the downtrend, and we want those to have a similar pattern. And what we said is that because of the nature of the construction of these oscillators, they tend to revert to zero if price is trending sideways for a while. So what we really wanted to make sure was that you didn't have kind of slap you in the face divergence, which is obvious price moving upwards and the indicators are obviously moving in the opposite direction. So that's what we were. Nina, I don't have charts right now. I'm just doing a recap on the prior webinars. So the charts I'm talking about are the ones you saw in prior webinars. So this is just a quick recap before we go to today's session, because we're talking about a month's worth of coursework, and it's nice to have a quick refresher, right? And the last thing we talked about in the third session was the concept of using multiple time frames, which is while we might do an analysis on any single time frame, it aids the analysis. It increases the probabilities if we look at higher time frames, and the story we get from higher time frames agrees mostly with the story we are seeing in our current time frame. Because often what might happen is we see a great story in a certain time frame, and we go to higher time frames, we start seeing contradictory stories, and that makes us think about the validity of the trade, right? So that's just the recap, and now we'll go into today's session. So in today's session, what we want to do is look at the trading strategies themselves, the momentum breakout strategy, the trend flow strategy. We're going to pull together everything we have learned so far, and then we're going to do some examples together. And this is a chance for you guys to ask me all the questions that you've been accumulating over these 4 sessions, right? So, well, I guess I do have some charts out here, but we'll go through them quickly. So first, thinking like a trader. Remember, as a trader, your job is to focus, on controlling your risks, or more than controlling or thinking about your profits. If you manage risks well, if you pick your trades well, the profits will take care of themselves over a large number of trades. But if you don't manage your risk, you don't manage your downside, you don't limit the amount you can lose in a trade, you'll be thrown off this market and empty your bank account or your trading account, right? And in order to reduce the impact of emotions in trading, focus on 2 things: your win-loss ratio, which is, out of 100 trades, statistically, how many could you potentially win, and your risk-to-reward ratio, which is how much are you willing how much do you want to make for the unit risk you take. So if you're willing to risk $1, how much should you make on average? And like I said, the quick answer for newer traders is make at least $1 if you're willing to risk $1. You might make more, but like I said, if you go for extended targets, which you want to make $1.50 for $1, then your win-loss ratio drops, and that kind of picking the right spot becomes tricky. So the straightforward high. By the way, I've done analysis multiple times. If you go for a simple one-to-one, say you get a certain percentage win rate, right? And now you go for a different strategy, which is taking extended targets or trailing part of the position and then taking half of it at one-to-one, etc. The incremental gain you get for fancy trade management isn't a huge amount over um, the simple one-to-one strategy. So you're actually very well served by going for a simple one-to-one strategy. We talked about the trader's mindset, which is just looking at trades, not focusing on what happens on any particular trade, but on the outcome of any particular trade, but really focusing on the input of the trade, meaning your job as a good trader is focused on executing your strategy flawlessly and not worrying about whether the trade was a winner or loser in terms of money. A winning trade in terms of a professional trader is a trade, or a good trade, not rather, a good trade in the mind of a professional trader is a trade that was executed flawlessly per the strategy. It's not whether a trade made money or lost money. A good trader thinks of a good trade as a trade that is executed flawlessly regardless of whether it won or lost, right? And what we've said is then if you focus on the basics of trading, um, that's what's going to make you successful in the long run. So optimal chart structure, again, smoothly flowing charts with nice, flowing upward trends or downward trends, and an uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower highs and lower lows. The trading zones again is the area between the 10 and 20 period moving average. The buy zone is is the zone when the price is going up. The sell zone is the zone when the chart is heading downwards. And like we said, is you tend to see this pattern of big candles when price accelerates away from the zone. That's when the buying kicks in. You usually see big candles. And when price pulls back into the zone, you typically see the candle sizes getting smaller, especially when it touches the zone. And here again, you see smaller size candles when price gets back in the zone, and you see that either buying or selling. And I also just pointed out that while you have this notion of price accelerating away and pulling back, sometimes you actually have pullbacks, but sometimes you have price actually just walking sideways while the moving averages catch up. So in this instance, you see price moving sideways until the moving average catches up, selling resumes. Kind of moves sideways, moving average catches up, selling resumes. And here again, you see kind of price just moved sideways for a while, the averages caught up, and the selling resumed. So you don't always, again, here, and charts tend to be self-consistent. So if you're wondering what's going to happen, just look behind in the same chart and see, okay, what is the predominant behavior on this chart? Moving sideways seemed to be kind of the notion, right? Sideways, 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 sideways. So this behavior of moving sideways into the averages before the sell-off resumes seems to be the nature of this chart, right? In this chart, you actually see more pronounced pullbacks. Every now and then you see a little bit of a sideways move, but the nature of this chart seems to be more of a push ahead, pullback, push ahead, pullback. Roberta is asking, is the reward to risk settings are only based on take profit and stop loss limits? I'm not sure what you're saying, Robert. Roberta, what I'm saying is if you enter here, if that's your entry, that's your stop, which you're picked for technical reasons. What I'm saying is the simple exit strategy for where you place your target is the same distance between this and this plus your spread, right? You have to account for your spread, assuming your charts, print on a bid, then you're going to add the spread when you buy, or if it's halfway, then you're going to add half when you buy, half when you sell, or depending if you're doing a stock, right? Then you got to, you're automatically paying the spread when you buy and ask. You don't adjust for it. You only adjust for it when you're doing foreign exchange because that's specifically added to one side of the trade, right? So I'm not sure what your question is, but yeah, what I'm referring to is the distance between this and this needs to be the distance between this and this for a one-to-one strategy. Okay, got it. That's what you meant, right? Small candles in the zone. We've already talked about this, how when price pulls back into the zone, the uncertainty creeps in, volatility dies down, you see those small candles, and that indecision is the point at which the overall momentum typically takes over and resumes the trend. True support and resistance, like we said, is where price is tested a level 2 times or more. And when this happens, it's likely that we might see this level be influential in future price action. So therefore, we spend the time to analyze our charts in the past to see where SR exists and just account for it one way or the other going forward. And the general idea is, where's my cursor? Okay, is that if you're entering here and your stop was here and your target was here, you want as much SR as possible between your entry and your stop to protect your stop, and you want the region between your entry and your target to be as free of SR as possible. Now, every now and then you're going to find some kind, you might find a prior daily high here, or you might find a pivot here. I mean, you're going to find the odd thing here, right? What you want to do is look in the past and just make sure that it wasn't the case that every time the price came up to this level, it was being rejected, and therefore there's a chance it's going to be rejected again. The odd presence of a pivot or a Fibonacci level or a prior daily high and low, that's, those lines are all over the chart. So you might find, a line or two in there. What you just want to make sure that it didn't significantly affect price in the past. Convergence was, like we said, in an uptrend, you look at the highs in the chart. So you look at the most recent high and the prior high, drop lines down and look at the corresponding points on MACD and RSI, and just make sure that as price was going up, these guys were going up or were flat. And similarly, in a downtrend, you look at the lows, compare the lows in RSI and MACD, and you want to make sure that as these were going down or were flat. Right. So why do we say have a clear trading strategy? Because there is a difference between, hopefully you're convinced by now that there's a difference between a trading strategy and just doing technical analysis. So we're not just saying trade if price enters the zone, or trade if candles are small, or trade if there's convergence. We're saying no, there's multiple things you need to look at. You need to put them together in a strategy because each one of them help you, but if you use them all together, they're helping you that much more. That's what we're trying to do, right? So having a trading strategy puts the probabilities in your favor because you're stacking multiple factors. It helps you define ahead of time your risk tolerance, which is telling yourself where are you going to enter, where are you going to place your stop, and therefore how big a position can you buy so that when you get stopped out, you're not losing more than your defined risk. And for this exercise, we're calling our defined risk 1%. Right? And then once you have a strategy, you need the confidence to select and execute trades that meet your strategy. That reduces the guesswork. You're not trading out over gut feel. You're not gambling. You're following a rule-based trading system, which is what professional traders do. Professional traders, by the way, aren't those who have some gifted, magical second sense or intuition that tells them what's going to win. That's not what professional traders do. Professional traders, I mean, those are gamblers who might get lucky every once in a while. Professional traders have a set of rules. They just ruthlessly execute them as best as they can, and over a long, set of trades, they hope they win more than they lose. And the idea between the difference between a strategy and a technical analysis is really strategies like, the technical analysis is like all the ingredients that or pieces you have when you're building a piece of furniture. You get a set of instructions that comes in the box that tells you how to build stuff. Sometimes there are stuff like you get from IKEA, which is really hard to follow. Sometimes, other places give you easy to follow instructions. Regardless, you get a set of instructions that helps you put the pieces together to build some finished product. In trading strategy, that finished product is a well executed trade. We talked about probability and risk, which is just saying strategic trades are constructed, means they consist of sound ingredients which are combined to increase the probability of your having a positive outcome, right? And we define risk before we enter the trade. So it's not like, hey, this is a good reason to enter, we enter, now we figure out, where would I place the stop. If you're approaching trading that way, then you've just bought a randomly sized position, and then when you actually place your stop, you might lose a lot more or a lot less than you wanted, right? So having your stop location first is essential to be able to pick the right position size, or you just picked a random position size and again you're gambling. Again, you can't guarantee against price gaps and slippage, which is risks all traders face. If you're worried about slippage and gaps, then trade a more liquid non-closing market like Forex. But if you're trading something like a stock market which closes every day, or like many of the commodities markets, you're always going to have a risk of gapping. What you hope, again, is you're playing the probabilities. Yes, while you might get gapped on any, one or two trades here and there, that's not going to happen repeatedly to you. And therefore, if you're limiting your risk by betting 1%, yes, you might get gapped and lose, 2% on that trade or 3% on that trade, or you might win 2-3%. It can go both ways, of course. that over a large number of trades, again, that's not going to keep happening, right? And like I said, the most important thing to keep in mind is you can calculate your position size in advance based on your risk tolerance, and we strongly recommend you go by the 1% rule. It's a rule that works now. It's a rule that will serve you forever, so why risk more? And you get confidence, by the way, as a result of having a well-constructed strategy, knowing the rules, believing in your skills in analysis, believing in probabilistic trading, exercising sound risk management, and being a disciplined trader. And this all requires having a what we call a trader's mindset, which is that positive mindset that reinforces the right behaviors, attitudes, and beliefs that support good trading. And I couldn't recommend more that you read Trading in the Zone by Mark Douglas, because that whole book is about developing the right mindset. And reading that book will do a lot more for your skills as a trader than learning another strategy or another technical ingredient. So I couldn't recommend that more. And by the way, when you have rules, it stops you from doing silly things. Most traders lose money because they're doing things based on instinct, on worry, on fear, on gut feeling, um, and and those all lose you money typically. So when you have rules and you stick to the rules, it prevents you from doing silly things. Right. And like I said, you're not trying to get rich on a single trade. You're trying to get rich over a large number of trades over a large number of years, and therefore your results need to be measurable, sustainable, and reproducible. Luck is not reproducible. Good. So now let's get into the strategies themselves. So the momentum breakout strategy has these following ingredients. Let me just pause and let you guys take a screenshot of this, because this is going to be your formal checklist, and you are going to use this as we go forward. So I'm just going to pause for 20 seconds. Usually shift print screen works, or I'm not sure what the equivalent is on a Mac, but just take a quick screenshot of this, and this will be your checklist. Okay, so let's go through this checklist. The first thing you need is a flat horizontal level that's been tested 3 times or more. Remember, we call SR when it's been tested twice, but for the strategy to work, we want a strong level. So we want a level that's been tested at least 3 times. And the more times it's been tested, the better, especially when you get convergence into that, compression into that level. Compression meaning if that's a flat level and you're approaching it from below, then while the top is constrained by the block orders that are sitting at the level, you want the bottoms to be pushing into that level, showing that increasing enthusiasm to buy, and that buying is happening at ever higher levels, and that gives us a sign that that kind of compression pressure is actually going to rupture the level rather than let the level hold, right? So you want the flat level tested 3 times or more. You want price to be making higher highs and higher lows in an uptrend, or lower lows and lower highs in a downtrend. Remember, you don't want, often on the chart side, you'll see a ranging chart and you'll suddenly see it form a flat level. In those instances, no matter how good the compression looks on that flat level, don't trade it, because you need that underlying momentum behind it to be driving the overall price action downwards. If it just happens to be accumulating there, it just means it met a block order for some reason, right? Somebody decided to dump their position and there's momentary resistance. Momentary resistance is not what you're trying to trade. You're trying to trade just a kind of speed bump in an otherwise smoothly flowing highway. You want convergence of RSI and you want convergence on MACD. And we say convergence on the break, meaning that as you watch the price accumulate at this level and you're watching what the RSI is doing, you're watching what MACD is doing, often you find these indicators will flatten on the level 2. And what happens is at the moment when it looks like price is going to break, you want to make sure that that RSI and MACD are already breaking, or they're about to break too. What you don't want is price about to break and RSI and MACD are far away from their flat levels. That's what we mean by convergence on the break. Okay. Next up, we want to make sure that there's no SR on the way to target and there's as much SR as possible between our target, our entry and our stop. You want price close to the buy and sell zone. So therefore, when we look at this flat level forming, we don't want the moving averages down here, because again, we know the greater likelihood is that price needs to snap back because of overextension, and therefore if it's already experiencing resistance for some other reason, then there's even more chance you're going to have a snap back rather than a breakthrough. So we would like these moving averages to be right at the flat level when it's breaking out, which means that price is in an equilibrium, and therefore it's more inclined to move forward than be pulled backward. Lastly, we exercise sound risk management, which is cap your risk at 1%. Okay, let's work through each of these with graphical illustrations now, right? Flat level that's been tested 3 times or more. This is the kind of pattern you want. Of course, this is a graphic. This is not an actual chart, but you want a graphic like this, your chart to look like this, right? Flat level, multiple tests, at least 3. If it's testing more than 3, that's great. You want to see this compression, and you want to see the candle size reducing. By the way, we have this concept, and this is not formally on the checklist, but I want to share it with you, of no wasted momentum getting to the flat level. And by that I mean, you don't want to see price getting to the flat level with, say, a big candle like this, right? Which means there's been a lot of enthusiastic buying that's got you to the flat level, and therefore the number of buyers who are potentially left in the market to break through have reduced. When you see small, steady candles creeping up to the level, there's very orderly buying in that market, and therefore it's likely there's dry powder sitting on the sidelines that can push it above. When you see, a huge candle that's brought you to the flat level, much less attractive. That's just a fine point. It's what I call a bonus factor, but I just want to throw that in. You can add that in your checklist. It's not out here. Right, so here we see a flat level tested 3 times or more. Next, you want price to be in a clear trend. Like I said, flat levels might occur in ranging markets or in random markets. You only want to be trading flat levels in a trend because you want to know that underlying momentum is there to push you through. And you do want these higher lows forming into a flat level, or the opposite if you are going short. Higher highs when you're going short. Lower highs when you're going short, sorry. You need convergence of MACD and RSI, and we just explained that, meaning if you get higher highs in price, or sorry, equal highs in price, you want higher highs in the indicator or equal highs in the indicator. You do not want the indicators to be falling off as price is breaking through. And certainly at the point in the break, you want that indicator to be at the flat level or higher. Again, we want SR to be clear to the target, which means as we scroll back, you don't want to see something like this, which is an area of congestion that's between your desired entry and your desired target. So if that was your stop, that's likely to be your target. If that's your entry, and then you don't want to scroll back and see all this price action here, that's likely to impede your movement before you get your desired target. Now, if this level, for example, was down here, right? So if you had this a congestion level up here that was between your stop and your entry, then that's a bonus factor. You look at that and say, yeah, there's something else that's going to protect my stop. I like this. Lastly, you want price close to the buy and sell zone. That lessens the chance that price is going to pull back from the flat level rather than break through. Okay, so hopefully you get that. And in terms of entry and stop placement, like I said, because we are trend traders, the most logical place to place your stop is behind a prior swing low. And obviously, as price is compressing into a level, you have multiple choices for swing lows. The tightest stop, which is the most recent swing low, is the most aggressive, meaning because it's closest, you're most likely to get taken out. But on the other hand, if you do have a good fast breakthrough, it's the one that's going to get hit first. And if you have a one-to-one entry to target, that's the one that's going to get you out of the market with your one-to-one profit the fastest. If you take the more conservative stop, which is one of the prior lows, that is still valid, but it just means you're going to be in the trade for longer in order to make your one-to-one. And that doesn't necessarily mean it's any safer, because price could very well hit the first target and then fall back and hit your stop before it gets to the added distance that you've implied by picking a safer stop. Now, often the choices between these two will be hard, and then you'll make it up by looking at other factors like what are the higher time frames doing? Is there any SR between this and this that convinces me that I should pick the safer stop? Uh, Things like that. But in general, the motivation for the stop in the momentum breakout strategy and the trend flow strategy is behind a prior swing high or a swing low, because that's the last place the market rejected the price movement in that direction, right? All we're saying is the last time price tried to go any lower, the market said, no, thank you. I think this is a good place for me to buy. And enough people are willing to step in at this point to push price higher. And we're betting that if price gets back down here, those same folks are going to step back in with the same enthusiasm and protect the stop. And so what we're doing is looking at the low of this candle. So you're going to go click on that on your charting platform, look at the low of that candle, and we add a 1 pip buffer. So the way we actually trade this practically is wherever this is, you add a 1 pip buffer, or if you're trading stocks, you can add depending on the size of the stock, right? I mean, if it's a $10 stock, you might add a penny or two. If it's like a 10, 20, $50 stock, you might add 5 cents or 10 cents. You're going to add a tiny buffer just below. No, don't go add 25 cents because that's meaningless. You want to add it's a small buffer at the bottom so that if price gets down to this level, a little bit of noise might take you just below that level, but that level might still hold. So in FX, we add 1 pip below and we enter 1 pip above the flat level. So wherever we're drawing the flat level, we add 1 pip buffer. That's our entry level. And 1 pip below the low of the swing low is our stop level. Now, like I said, if your charts are printing the bid, then we also add the spread when we buy, right? Because the spread is what we pay on which is added to the ask when we buy. Sorry, let me say, because charts print bid, right? The price you're seeing on the screen is the bid price. When you buy, you're buying at the ask price, right? So even though this is what the chart is printing at the moment it breaks through, this is what you have to pay at that point in time in order to own the position, right? So you have to add the spread above that 1 pip buffer. And so therefore your entry is actually going to be up here when you actually get filled. And so typically when you're trading FX, what happens is you get filled and you see an instantaneous loss on your column. That's not really a loss. It's a function that this is where you bought, that's where price is currently, and your platform will show a loss because if you sell right now, you turn on and sell instantaneously, this is the price you can sell, and therefore that's a small implied loss, and that doesn't show a profit until the bid climbs above this ask level, and therefore now you'd be in profit. So typically when you first get triggered into an order, unless it's moving really fast in your desired direction, you'll first see a little bit of an instantaneous loss in FX, and then if price keeps heading in the direction you want, it'll change to neutral and then change to a profit. Okay. And obviously the mirror image if you are shorting, which is you're going to enter 1 pip below the flat level. Your stop is going to be one pip above the tail of the swing high that you pick as your stop location, and you're going to add sorry, when you're selling, sorry, let me just point this out because it's a little tricky. When you sell, you're selling at the bid, right? So you will actually sell at this price. But when you buy back, you can't buy back here. You will have to buy back here plus the spread. So actually this is tricky. Good thing I thought about that. Let me clear out these markers and explain it again. When you buy, when you're entering long, you will actually place your 1 pip and 1 pip, and you'd enter plus spread, right? You're going to enter plus spread. When you're shorting, you will actually sell right here. So you'll sell 1 pip below the flat level. Your stop will be placed 1 pip above the swing high. But because you're buying back when you get stopped out on a sell order or a shorting order, this is where you're going to be buying back, right? So you have to add in the spread to that location. So when you say, what am I willing to pay to close out my position, that's the value you're going to type in, because again, if the chart is printing bid like most charts print, then you have to add the spread whenever you're buying. So in a shorting order, or you're going short on the chart, you're buying on the exit, whereas if you're going long, you're buying on the entry. Regardless, you add the spread when you buy. Does that make sense? It's a little bit confusing for people who are newer to Forex. If you have any questions, ask me, but that's how you do it. And again, if you have a platform like I believe FX Trade is, where it prints bid plus ask divided by 2, then you're going to add half the spread when you enter and half the spread when you sell. So on this position, you would add bid plus ask by 2 out here, and you would add bid plus ask by 2 out here. So both on the buy and the sell, you would add half the bid plus ask, or half the spread. Okay. Now, right, here's just an example here. You have a downtrend, and though you can't see much of the chart, it's a downtrend because you have the moving averages in the right order. You have your 10, 20, 50, 200 in the right order, and therefore, especially since the 200 is up here, it wouldn't have gotten up here unless price had been heading down nicely for a while. Because you can look at this and say, hey, look, if this is all you showed me, this looks like a sideways chart, right? If that's all I showed you, you'd say, hey, isn't that one of those ranging charts you told me to avoid? And you would be right if that's all I showed you. But then you look at this now and you know that you won't have the 200 period in the right order unless it had been moving down nicely for a period of time, right? So then we're seeing prices move down, and typically in the higher time frame chart, we're probably seeing something like this, and you're seeing the most recent pullback that's getting to turn around, and on this most recent pullback, right, it has encountered a block order, which is creating the flat level, right? There's enough supply to meet all the enough demand to meet all the supply at this point, which is why it is causing a flat level to happen out here. That's your entry level, that's your stop. And in terms of our checklist, which is what we're trying to do now, which is to start referring to our checklist, we see a horizontal level that's been tested multiple times. And by the way, when price does this, I actually call that a single test. I don't blow it up and call that 1, 2, 3, 4 tests. A test to me is a touch, a nice clean breakaway, a touch, a nice clean breakaway, a touch, a nice clean breakaway. Sometimes you'll find basically sideways price action for a while. All of that is one touch, right? So in terms of this chart, I see 1 touch, 2 touch, 3 touch, and 4 touch out here, right? Or maybe you call this combined 3 touch, but that's where we are seeing 3 touches, and we are seeing compression across the tops, right? We are seeing MACD and RSI kind of flat at the bottoms. Remember, we're going down, so we're going to look at the bottoms, and that's kind of flat. That's kind of flat. Now, as I mentioned, if you go, you're really looking at the most recent touch and the prior touch. If you go further back, you'll actually see this line is a little bit lower. We don't worry about that. Actually, it's fine on RSI, but on the MACD, it seems lower. That's because, like I said, these are mean reverting indicators because they're oscillators. They're going to come back towards the zero value, and therefore you're going to see that. So always focus on the most recent touch and the prior touch and look at what those two are doing, right? On this chart, we don't see much by the way of obstacles onto the target, so take it on faith that the target is clear, and therefore if you place your stop here, now again, you could have placed your stops here. That would be a really bold choice and it would be a valid choice. And I've got certain colleagues who love to trade that way, and the reason they trade that way is because they hit 1 target, 2 target, 3 target, 4 target, and they make 4-to-1 on this trade by the time somebody who placed their target stop out here has made 1-to-1. And yes, they don't hit 50-50 win-loss rate. They're probably winning 40% of the time, but if they're winning 4-to-1, then the math works out quite well in their favor, but it needs a different DNA to trade like that. Okay. Where are we? No obstacles, and price is close to the buy and sell zone. You can see the zones are all compressed out here, so that is a check too. And you can see price has broken through. It's hit the 1-to-1 target and moved on nicely to hit additional targets. Now, like I said, if you picked a more aggressive stop, you'd have hit a higher win-loss. And if you picked a more conservative stop, you'd still be in the trade, right? Actually, no. If you pick this as your entry, you'll probably be at or close to 1-to-1 out here, depending on what the spread was. What you want to do is make sure, for example, this is a qualitative fine point, which again comes under bonus factors, but or not so much a bonus factor. Say, for example, this high was up here, right? That again would have been a valid location for the stop. But if the corresponding target went down here and this low was sitting here, that would count as SR on the way to target, right? Because this is where the overall market last rejected downward movement. there's a good chance. Look, that's one touch, two touch, three touches here, right? It tried 3 times to break through here before pulling back. Now we're betting that the overall momentum is still there, and this was just a standard pullback in the trend or a swing in a trend and not a real area of SR heading downwards. But if the pullback was this high and you picked that as your stop and that forced your target to go down here, then that's bad trading, right? Because now the likelihood is that you're going to see some resistance here. You're hoping it's going to break through that, but you're going to see that resistance before your target. That's not good. So the only valid choices here then are this. Even this is not a valid choice at its current height because it's about where this is going to be. So you're going to get your 1-to-1 just about where the market hit some traffic the last time around. That's not a good choice. So really your only valid choices are this one, this lower one, and the one we actually picked. Make sense? Okay, where are we now? We're about halfway through, and it's a little bit early, but I need to take a sip of water. So what I'm going to do now is take our 5-minute break right now, and then we'll come back and run with the rest of the webinar. And if you have any questions on this, pop them in. And as I take a sip of my coffee here, we will answer those questions. Thank you, Dave. I forgot I muted myself. Right, so we are back. There weren't any questions in the break, so we're just going to start with the trend flow strategy. What I'm doing here is just putting up a little slide I pushed up in the break on the causes of support and resistance. And if you want, you can take a quick screenshot of this because this just recaps all the things you can look for. No, Robert, I haven't shown the checklist yet. I'm going to get to that next. I'm just putting this checklist for causes of SR so you can just remind yourself on the various things to look for in your charts. Sometimes people also add things like, the 200 period moving average or the 100 period moving average because often people trade when prices bounce off those. Less reliable because those move around a lot with every candle, so it's hard to pinpoint where that's going to be at the point you place your trade. But yeah, these are the more important ones in terms of causes of SR. Okay, trend flow strategy. This is the checklist. Let me pause for about 15 seconds so you can take a screenshot on that one. Okay, so the trend flow strategy again can be broken down into a list of steps that are simple to follow. We're going to look at each of these steps in more detail in the coming slides, but again, it's important to remember that this is a sample strategy and what it might look like for a trader. There's many ways to bake a cake, and there are even more ways to go about trading the markets. This is just one set of rules that when combined seem to give you an advantage in the markets, right? And it shows how we combine some technical ingredients that we have covered in the last few weeks. And in actual trading strategy, you might have refinements on these that kind of what we call bonus factors, and I'll talk to you a little bit about the end about some of the bonus factors you can look at on both these strategies to increase the chances of your trade working out. So the way we look at them, they're not essential in the sense that they're missing doesn't mean it throws us off the trade. But for example, if any one of these things is missing, for example, if we don't have a small trigger candle, you only have a big one, we just walk away, we don't take that trade, right? So bonus factors are if they're not there, well, they're not there. That doesn't necessarily throw us off the trade, right? So we're not saying this is the only way to trade or these two strategies are the only ones that work. There are obviously lots and lots of strategies that work for different traders. And there's a lot of reasons why different strategies work. You need to find something that works for you. This is just an exercise in showing you how we look at technical factors and how we assemble them in strategies that give you an edge in the market. Okay, let's walk through these, and by now this should be fairly straightforward for you. First thing you need on the trend flow strategy is a trend, right? You want price trending up on the chart, so a nice series of highs and higher lows, or if you're shorting the chart, series of lower highs and lower lows. You want the moving averages to be correctly aligned. So you want that nice moving average geometry in the right order, fanning out, white space between them, and hopefully the 200 in order, but at least the 10, 20, 50 in order, right? So that's what you'd like to see. You want this price to have been pulled back to the buy and sell zone, which is again the area in and around the 10 and 20 period moving average. And you want that little small candle there. So you want the small trigger candle, which is bullish in an uptrend, or you want that to be a red bearish candle in the downtrend. And you want that candle to be again in and around the 10 and 20 period moving average zone. You want RSI and MACD convergence, which again is you want the highs in an uptrend and the lows in the downtrend to be in agreement in terms of shape. We're not concerned about the values of the RSI and MACD. We're not concerned about the right axis. We are just looking at shape. And lastly, again, you want SR to be acting on your behalf and not against you. Okay, so what is the mechanics of this strategy then? When you have that small trigger candle in the zone, you want to enter. So here's how it actually works, right? So you're watching this chart. Where's my cursor? Right. So you're watching this chart, and say you're watching the 1 hour chart, and you see this small little bullish candle form, right? And now it's like 45 minutes to the hour, and you say, hey, that's a nice small bullish candle. Let me buy now. No, don't buy now, because you don't know what's going to happen with the end of the hour. I can't tell you the number of times something looks great 45 minutes into the hour, and by the time that hourly candle closes, the picture is indecisive or it's actually gone bearish, right? You don't know what's going to happen by the end of the hour. Now, that's one of the things actually I found hard when I first started trading these strategies was, why should I sit on my hands? Like, if I get in now, it's a better price. Why do I want to wait until I get in here? Right now, I'm able to get in here. That's a better price. Let me jump in. No, actually, that's hurting you, because you're guessing what the market is doing. You're not trading when the market is doing what you already wanted to do, right? So first thing is, let that candle close. So once the candle closes, like you can do all the calculations for the setup, right? In the sense, you can see currently where's the high, currently where's the low, and start doing the calculations on the setup. And if that changes by the end of the hour, then you change the calculation. But I have an Excel spreadsheet so to do my calculations for me. So this is really, really fast. If it changes, I just type in a new number, and it gives me the values. But what you want to do is first let this candle close, and then say, okay, where's the top of the candle? Where's the bottom of the candle, right? And then you're going to add that 1 pip buffer on the top, and you're going to add the 1 pip buffer below, right? And those are going to give you your entry level and your stop level, right? And then again, if you're going long, you're buying. So you can't actually buy here, which is the bid on most charts. So if you're printing bid on the chart, then you can only buy at the ask, and the ask is going to be the bid plus the spread, right? So your actual entry is going to be up here, and that's what you're going to place in your order. In your order box, you're not going to place this value. You have to place this value, because that's what you have to pay when the chart actually comes up here. Got it? And then what happens is, so you place these orders, right? So you're going to actually say, I'm going to get long here, and I'm going to place my stop here. Then you sit back and watch what the market does. It's going to do one of two things, right? The next candle is going to start, and the price is going to move around up and down that candle, or maybe a series of candles, and then it's going to either continue pulling back and break your stop, in which case you cancel your order. So if your stop gets hit before you get triggered in, cancel the order, because your assumption that this was the swing low is no longer valid. Your assumption that this is where the market reached equilibrium and is going to turn around is no longer valid. So after this candle closes, if the price then moves through where your stop location was before you get triggered in, cancel your order, because that trade is now invalidated, right? On the other hand, if that price moves through and then breaks the high of this candle, that's a confirmation that yes, volatility reduced, price is turning around, and it's pushing to higher highs, right? That's the essence of the strategy, is that price came back, reached an equilibrium, and then it was in the zone, and the market now felt that it's time to push higher. Whereas these candles are all breaking lower lows, on this one, once it hit that zone and the market was able to push higher on a bullish candle, break the high of a bullish candle, that's the market signaling to you that maybe confidence is returning, to head back higher. That's when you want to get triggered in. Now, once you get triggered in, what do? Nothing. Now is the hardest part of being a good trader, which is you sit on your hands and let the market take over, right? It's very tempting to sit here and meddle and say, okay, as price comes back down towards my stop, you see the red in your column, you don't want to get stopped out, you slide your stop a little safer down. All those kinds of behaviors are just bad trading, right? Once you've decided this is the logical place to place your stop, and you see your price is sinking down, and you don't want to take a loss, and so you slide your stop downwards, you just said, like, all that analysis I did before was nonsense, right? Because I'm so willing to move my stop lower just because I don't want to get taken out. It means all the reasons you entered in earlier must have been invalid for a reason, and you're basically fooling yourself, right? So once you place an order based on a strategy, the hardest thing to do as a professional trader is sit on your hands and let the market decide what's going to happen next. And one of two things is going to happen, right? You have a 50-50 chance of your target getting hit or your stop getting hit. One of the two is going to happen. But again, what you're trying to do is, if you execute flawlessly, you're hopeful that over a large sample set of trades, all these various factors you put together that are supposed to push advantages in your favor will actually push them in your favor, so that more often than not your target gets hit than your stop gets hit. But don't meddle with the trade once the trade is underway. That's one of the hardest things for traders to overcome, is this impulse to jump in and fiddle with the trade. Or what happens is you see it quickly go towards your target. It's like, hey, I'm winning. Let me slide that target slightly higher so that I can make a little bit more profit because it looks I was right. Because very often you might just go up to your original target level, turn on, and boom, get stopped out. And trust me, I've done this so many times it hurts, right? When I was starting off, and now I've learned, just how to discipline that once I place my trades, I just walk away. I don't look at them again until I get a signal saying, okay, that trade is closed, right? Um, Unless it's been moving sideways for a very long period of time, and then I look into see if I should cancel the trade or just take a smaller profit for some other reasons. But don't do that when you're starting off. Let the market either take you out at full target or full profit. Another error that traders often make is, it goes in here, that's your target, and it goes up and it'll be wandering around like 50 to 60%, 50 to 60% for a while. You get bored and you take your profit at 50%, right? So you lock in a 0.5 win, but the problem is on a 50-50 win loss, you're going to get that -1 loss at some point in time, right? Because on a 50-50 coin toss, it's the same number of wins and loses, and all you've done by taking a 0.5 win now is you've eventually locked in a net -0.5 loss. Does that make sense? So the mechanics of trading are easy. The hard thing is having faith to let the market do what it's going to do and let the probabilities play out on their own. But again, just in terms of the mechanics of the trade, wait for this candle to close, calculate 1 pip above for your entry, 1 pip below for stop, add in the spread when you're buying, and similarly here, if you're shorting the market, 1 pip below is your entry, that's where you're actually going to sell. 1 pip above your candle is where you're going to buy back in if you get stopped out, but you have to pay the spread. So this is the actual value you're going to enter in your stop loss order, which is your desired stop location plus the spread. Okay, makes sense? If you have any questions, ask me, but hopefully this is making sense to you by now. Okay, so let's do a graphical example. I think what's the euro versus the Aussie dollar 1 hour chart. Again, nice trend. You can see the 200 is down below, which means it's been going upwards for a while. Nice convergence on those indicators. You can see the trend is going upwards. Now again, when you look at trends, right, there'll always be imperfections in the trend. So for example, you see like, a low, a high, higher low, higher high, higher low, higher high, higher low. That is actually a higher high, higher low. This is actually a fairly good trend. Goes up here, kind of went sideways here. Somebody might say, was this a low? And did it kind of make a lower low? You're always going to see those kinds of imperfections, right? So step back and look at the big picture and say, look, it was here. This was just a little bit of a wiggle as it was pulling back to the averages. The minute it met the averages, selling resumed. So yes, this is still a good trend. So you're always going to make judgment calls on these trades. What you want to make sure is that something is not just so bad that it's invalidating the basis of your strategy. But yes, so what we have here is, as we go through this checklist, number one, price is making a series of higher highs and higher lows. Moving averages are in the right order, nicely aligned. Price is in the buy zone, it's pulled back. You are seeing that small bullish candle, and RSI and MACD are converging nicely. Got it? Everything in our favor. And this was our trigger candle out here. Do I have more? Okay, I haven't drawn in the lines. But this is the trigger candle, which means you would have placed your entry somewhere here. The stop would have been somewhere here. And had you, hung on to your trade, I mean, if you're taking 1-to-1, you'd be out here and you'd be happy. And don't be one of those to say, boy, if I hung in, I'd be 2-to-1, 3-to-1, 4-to-1, 5-to-1. Look at all that money I lost out on. Yes, but you could have also been in a situation where it went up, hit 1-to-1, and then turned around, and you'd have been happy that you took your profit 1-to-1. Like I said early on, you actually make more money taking 1-to-1 than trying to go for more aggressive targets, right? So multiple targets reached. So now I'm going to turn over the exercise to you, and it's your chance to start practicing everything you've learned. And this is practical one. I'm going to give you guys at least a whole minute to look at this. Look at these two examples. You have Euro CHF, which is the European Euro versus the Swiss franc, 2-hour chart and the 4-hour chart. So that's 2 hours and 4 hours. So in our terminology, that's P and that's P1. And look at these two and analyze, again, you don't know which of the two strategies we're looking at. Think of the momentum breakout, think of the trend flow, and analyze these two charts, look at your two checklists, and decide what you would do if this was the live markets. So again, it's good for you now to start taking a stand, because that's what you're going to do with your money in the market. So actually type in your answers in the Q&A box. That's your low risk stand until you actually start placing trades in the market. So write in the Q&A box what strategy you see and what you would do. Thank you, Nina. Okay, the rest of you, I want to see some answers. Thank you, Maureen. Thank you, Jose, Adrian. Good job, Roberto. Yep, Robert. Okay, I see all the answers coming in now. I don't see any wrong answers so far. Looks like all of you understand what's happening, and that's great. Okay, let's just work through this together then. Good. So let's walk through this together, right? So price is trending on the setup chart and on the higher time frame. The moving averages are correctly aligned and fanning. The price is in the sell zone on both time frames. You see three small bearish candles in a row, or at least two, right? This is not really bearish, but certainly this is bearish and that is bearish. Actually, the first one is probably, yeah, this is bearish. It's closer to indecisive to bearish. This one is certainly bearish, but you always look at the most recent candle for the setup. And by the way, let me just point out this fine point, right? So say this was a swing high up here. Say this candle had a slightly higher high, and that was your setup candle down here. Let me clear the marker so you can see what I'm saying. So just imagine, for example, that this candle went a little bit higher, right? And this is your setup candle. You would enter on the break of the setup, but you would actually place your stop up here, right? So sometimes you'll see this where you have a swing high, and then the next candle starts with its low so low that the distance between this to this is what decides whether the candle is small or big. So not the size of the candle itself, but the likely distance to your stop, because right, so if this is where the swing high was and this was indeed the setup candle, you'd still be forced to place your stop beyond this swing high, right? Because if you place it behind here, there's no logical protection, because just now the market is tested above that, so that's not a logical place to place your stop by itself. So you would need to place a stop behind the swing high, and so therefore all of this is your risk, and therefore to push your target down here. And so this isn't exactly small, right? If your candle is this big, or this is the amount of risk, that would judge small or large. So that's again a fine point, but please note it because it's important. So don't go solely off the size of the candle itself. Go over where you would have to enter relative to where you would have to place your stop, and see if that is small. Okay, but right now that's not the case. You have a small candle in a close by location for the swing high to place your stop. RSI and MACD are convergent on both charts. There's no visible SR that's visible on these charts, and so therefore, looks reasonable. It would have to check higher time frame charts, before you do anything further. By the way, one of the things you notice out here is, if you eyeball, you see that there's a line of resistance out here, right? And it's unfortunate that this is not coming right up to it, but often you'll see something like this where you have this line of resistance here, and your setup candle actually is breaking that line of resistance. That's great, because what happens is, or your swing high breaks that line of resistance, because it means you're going to place your stop above there, and then all this SR protects your stop. So that kind of setup is kind of a bonus factor setup. It's more attractive. Kenneth made a comment, and I want to understand what you're trying to say, Kenneth. Kenneth, you said that you would not buy because you don't see full candles. What do you mean by full candles? This is actually a pretty good setup, because if you saw a candle like this, right, that is a bearish candle, because what you're seeing is a candle like that and a body down here, which means that relative to the range of the candle, the battle is finished way down at the base, which means the close is near the base, and so that this is a bearish candle. So the market tested and rejected all the higher prices. Sellers were willing to sell all the way down here, before they met enough buying interest, and so therefore this is a bearish candle. So I'm not sure what you meant by your candle, but I'm sorry, by your comment on candles. Adrian says your setup of the stop loss might be a problem with Oanda. I'm not sure what you mean by that. Adrian's making a comment saying the setup of the stop loss might be a problem with Oanda. Sure. I mean, Adrian's referring to when there's news and then, spreads increase to. By the way, if your spread is increasing to 25 pips, you need to talk to your broker. That's pretty unusual for your spread to increase that much. Maybe, if you have a half pip spread that increases to 2.5 pips or 3 pips, I get it. But 25 pips, I've never seen a 25 pip spread. Okay, maybe just formulate your question again, because I'm not understanding what you're saying. But if what you're saying is that if you enter here and you have a tight stop, that news can take it out, of course news can take it out, right? I mean, if this is not obvious to all you guys already, news trumps technical trading. There's no two ways about that, right? News is going to move a market. Technical trading is looking at historical chart action behavior and saying, based on aggregate emotions driving the market and aggregate behaviors, aggregate decisions, because people are generally invariant, because the way they make decisions are generally invariant, because you have the same kinds of players in the market, what they've done in the past is likely to be what they're going to do in the future, and therefore we can make some kind of predictions about what's going to happen next, right? But if you bring out news, so you're trading in an Apple stock, and suddenly it comes out that they've lost market share, that stock's going to drop. There's nothing that technical analysis can do to stop that, right? Or if you're trading euro dollar and then the Janet Yellen and the Fed comes out and says that they're going to stop quantitative easing, then all of a sudden the dollar is going to change dramatically. So you can never compensate for news. That's always a risk in the markets. But again, you're playing probabilities. Well, it might affect any one trade. It's not going to affect every single one of your trades, and therefore if you're fearful that news is going to take you out, you'll never trade because there's always a risk of news. What you want to do is place your stops, and if there's fast moving news, that's why you're going to get taken out, but you'll get taken out for a measured amount of risk. You might get a bit of slippage, but you're not going to get like a 20-25 pip slip. um, Let me just read the questions here. Sure, Adrian, the spread can change, but if spread changes, the prices also change because spread is tied to the prices you can buy or get. So it doesn't matter whether price action is moving the price or changes in spread is moving the price. In moving the price is a move in the price. Um, Robert's asking, on the chart you see the time interval says 2 hours and 4 hours. Do you recommend to zoom in the two charts to intervals? I'm not sure what you're asking, Robert. No, this chart is not in days. This chart is a 2-hour chart. Can you see up here? On FX trade, that was a 2-hour chart, and that's a 4-hour chart. What you're seeing is, obviously multiple bars. So, in effect, this is probably 2 hours. So that's probably 1 day. That's probably 2 days worth of bars. But what you're seeing, every 12 bars is a day, right? So that's about a day here. That's about 2 days here. That's about 3 days. You're seeing 3 days worth of bars, but this is a 2-hour chart and a 4-hour chart. And I don't know if this is the question you're asking about zooming in. Yes, sometimes what happens is if you're seeing a 2-hour chart setup, you might go look at the 1-hour chart, the half-hour chart, and the 15-minute chart to see what the fine structure is doing. And sometimes that can influence your decision, but often you try not. I mean, the way we do trading is we don't look at the lower time frames. If you have a setup chart, the fine structure below the setup chart is not greatly influencing our trading decision on this time frame. Now, there are a few instances which are a little bit too esoteric to get into in this webinar as to when we look at lower time frame charts. But by and large, this is you just look at your setup chart and the higher time frame. Okay, here's the higher time frame chart. Now on this time frame chart, all we're doing is just saying, if you're looking at the fine structure down here, zoom out to a higher time frame to see if you see things out there that would throw you off the chart. Okay, here is the second practical. Again, I'm going to give you about a minute to analyze it, and then we'll talk about it together. Okay. Thank you all for the answers coming in. Go long, trade the uptrend. Some divergence on indicators. 3 touches, bullish candles. Okay, good. I see all of you are thinking about this in the right way. So let's walk this together, right? Um, So again, price is trending on the setup chart and on the higher time frame, and what we're seeing here is an 8-hour and a daily. And by the daily is 3 times the 8-hour, but most charting platforms won't give you a 16-hour chart. So if you happen to be seeing a setup on the 8-hour chart, then your only real option is to go look at the daily chart, and that's what we are doing here. Some trading platforms will let you look at the 16-hour chart, but most of them will just give you 8-hour and in the daily, right? So what we're seeing is price is trending on the setup chart and on the higher time frame. The moving averages are correctly aligned and fanning. The price is in the buy and sell zone, or rather buy zone on both time frames. You are seeing a small bullish trigger candle. The RSI is diverging on P and flat on P1. MACD is diverging on P but converging on P1, right? Because out here, for example, if you look at the highs, because this would be the high and this would be the most recent high, there is divergence here, right? It's small, but this it's clearly it's falling off, and that's divergence. By the way, in the pullback itself, you are going to see it drop because it's pulling back. You would expect it to pull back. What you're looking at is just the high. So don't look at this fine structure here, which is what happened after the pullback, because that's what you would expect the indicator to do in a pullback. It's just showing you that a pullback is in progress. What you want to look at is the highs, right? So that's the high, and that's the prior high, and you want those to be converging, and obviously out here they're not converging, there's divergence, and out here on MACD too there's divergence. On the higher time frame, there's, depending on how you look at it, there's either divergence or there's flat, but there's pretty decent convergence on the MACD. So what you have here is, definitely 2 out of 4 are not good, and therefore that weighs into our evaluation of the trade. Now if it's this is not good, the MACD down here is not good, the RSI is not good, so this would definitely make me question whether this is a good trend. I'd have to see a lot of other factors here that would make me love this trade. Okay, so, but again, no SR or obstacles in the way of the target, right? So most of the elements of the strategy are present here, though the indicator divergence shows that the trend might be running out of steam. And in such cases, you might either decide to, not take the trade if you're conservative, or just go for a one-to-one target, right? So you might say, look, yeah, I still like it for other reasons, and I'm just going to enter here, my stop here, and I'm going to get out before here. But again, this is one of the instances where, because you have a small candle and you've got the swing low further away here, and this prior peak isn't very high, even one-to-one is going to take you pretty close to the prior peak. I would sit out this trade. If this was actually my chart right now that I was looking at, I personally would sit out this trade, because it just means that I'm going to get one-to-one if I'm lucky. There's some signs here telling me that this thing is running out of steam. I'll just go find a better chart. There's nothing that's forcing me to take this chart or go hungry. There's another chart out there that I'd rather trade. Okay, but again, another thing you could also do is check higher time frames, so you don't let divergence alone scare you away, because we're not seeing any reversal patterns or things like heads and shoulders or multiple touches at some level up here. But again, if this was me, I would not probably take this trade. Here's a third example. Again, as usual, I'm going to give you about a minute to look at it. Love to see your answers. Thank you, Kenneth. Yep, there's a potential. Kenneth, just think about your answer again. Maureen, think about your answer again. Adrian, you're on the right track. Robert, that's a good observation. Robert's pointed out there's a couple of spiky candles on the chart. Generally true. Now, what you want to look for, Robert, in that instance, for example, um, go look up like the Euro CHF chart right now, right? If I have time at the end, look at the Euro CHF chart in the weekly. That's what you call a spiky chart, right? I mean, just non-stop spikiness, right? Here, what you're seeing is a couple of big spiky candles. When you just have a couple of big spiky candles like that, that's a chance that there was a news announcement. The market didn't know which way to react. It spiked up, spiked down before it kind of settled down and headed out. What you want to avoid is charts which are just non-stop spiky. Every chart's going to have occasional spikiness, which reflects a news announcement coming out. Occasional spikiness, not an issue. But I'm glad you're looking out for spikiness. It means you're paying attention. Much better, Maureen. You're right, Nana. Jose, you're on the right track. Okay, this one seems to have caused a lot more confusion, and that's good because that means you guys are thinking about applying the rules and how to apply them. Let's work through this together, right? Okay, so given the distance between the price and the zone on P1 and P2, this is not a trend flow setup. But even before we go there, what kind of trade are we looking at? Some of you initially put in that you would go long, which just surprised the heck out of me because you have the 200 above and you have the 10 period below. So if you're going to do anything on this chart, you're going to go short, right? Because the chart is heading downwards. I'm not sure why some of you thought this was a chance to go long, which means you want to ride this chart upwards. When you have the 200 period, the 50, the 20, and the 10, your only option is to go short. Otherwise, you're going counter trend, which means you're trying to trade from here to here, which is a very, very aggressive style of trading, right? Because your potential reward is going to be limited to the size of any potential pullback. So if you're trying to go long here, you're betting for some reason that you're going to pull back this much and that's your potential reward to risk. That's just scary trading. You don't want to be trading with such a small potential reward. You want to be trading in the predominant direction of the trend. So if any of you wanted to go long on this, scary trading. All right, so first off, we are in downtrends because the moving averages are all ordered fastest at the bottom, slowest on the top, and therefore this chart is heading south, right? But the point many of you pointed out is that right now the candles are far away from the zone, and therefore even if you're going south, this is not yet the time to try the trend flow strategy because there's space between the price and the zone. Now, what some of you have noticed, oops, so very few unfortunately, where's my cursor, is that you actually have a flat level here. Right? This is a potential setup where you could be applying the momentum breakout strategy. Okay, you have a flat level that's been tested 3 times or more. Yes, we have 3 touches on P. The price is in a confirmed trend. The trend is present both in P and P1. You have convergence of price on RSI, an indicator on the break of the flat level. So you can see out here, where's my cursor? Why do they make this cursor so hard to find? Okay. So out here you have flatness on the RSI and you have flatness, and it's kind of heading a little bit upwards on the MACD, I have to admit, but not huge, right? Certainly on the high time frame, very nice, right? Flatness, fast drop. So momentum has already headed way south. It's not even bothering with the flat level on MACD here. So you got good convergence on P1 and acceptable on P. Okay. Um, there's no SR that we can see on the way to the target, uh, and the price is pretty close to the buy and sell zone on the trigger chart, which is out here. So this is not close enough for a trend flow kind of strategy, but certainly in terms of the momentum breakout strategy, you just need it to be close to the zone, so there's not a massive chance of snapping back to the zone. So it's acceptable on that factor too, right? Um, the closeness again is slightly debatable. You would like it to be closer, but it's certainly not grossly overextended, right? So this would not be a good setup chart. So if you saw P1 first, this would not be an acceptable setup chart because there's quite a bit of overextension on this time frame, and therefore this is not where I would start going short of the chart. But certainly in this time frame where I can see a lower high out here, which would get me out from here, this would be acceptable as a chart to consider, right? So we do have a potential momentum breakout trade here. Again, it would be nice to see even higher charts to know. Now, admittedly, if I saw this setup, I would not actually take it because I don't love this chart structure, right? Just starting the basic, the number one item on our checklist was good chart structure. And as I think Roberto pointed out, you have spikiness. This is kind of a fairly big swing up, a fast fall down. This is not the nicest chart structure, and that might keep me out. But it certainly meets the rules of the strategy. And by the way, I should let you guys know that I tend to be an ultra conservative trader. My friends, colleagues, and my mentor often knock me for that because I leave far more trades than I take, and that's my own trading style. Some of them are more gutsy, they take more aggressive trades, and some of them do correspondingly better for that. So again, it depends on your own personal trading style, and I just want to throw that out there. So if you see me being conservative on what I won't take, it's just because by my DNA I'm a more conservative trader. Some people are just more aggressive and therefore take a lot more trades, and the way they manage the trades ends up with them being profitable. Okay, another practical here. Again, I'm going to give you about a minute to look at it, and we'll talk through it too. Love to see your answers. Okay, great to see all the answers coming through. Excellent, Maureen. You picked up what we wanted you to pick up. Good job, Kenneth. Adrian, there's 3 charts here, so take a little bit of a closer look. Okay, good. Let's analyze this. Yep, you got it, Adrian. Thanks, Nina. Okay, let's analyze this. Right, so this example actually ends up being a combination of both strategies, right? You see a flat level forming on P, right, with 3 touches out here. And now, where's my cursor? Okay. you can see out here there is a flat level forming. So again, first of all, that's the direction of the trend. So the flat level is an interruption in the trend, right? So far, so good. And yes, some of you have pointed out that the moving averages are crossing out here, but on this time frame, that's because the flat level is forming and price is actually walking sideways on this time frame. But if you look at the higher time frames, the moving averages are well resolved, and those are a sign that the momentum is pretty clear, right? So let's get rid of that for a second. Okay, so uh, so once again, we see a flat level forming on P with 3 touches, and the crossing MAs and local downtrend on P invalidate a trend flow setup on P. So those of you who said that no trade on trend flow because the averages are crossing, you're spot on there. However, if we look at P1 and P2, we see we have a strong candidate for a bullish trend flow setup on P1, right? Because on P1, price is trending on P1, price is trending on P2. Moving averages are correctly aligned and fanning on both P1 and P2. Price is in the buy and sell zone on both time frames. There's a small bullish candle present on P1. RSI and MACD are converging nicely on P1 and P2. There's no SR that we can see on this chart. So what we have here is a trend flow set up on P1 and P2, but as a bonus, it looks like a flat level is forming at a lower time frame P, right? And what's going to happen is that a break of this flat level is also going to be a break of our trigger candle on P1, and that kind of adds to the attractiveness of the trade, because what it's saying really is you are forming a flat level out here. That's giving you a lower bound to this range out here, and therefore, this overall momentum has basically on the higher time frame, this sideways price action has just allowed the moving averages to catch up. Now that it's caught up, you're getting a nice little bullish candle here. The basis of multiple candles have been at this low. So this big pullback candle down here, and then the next 3 candles have all been constrained to a low. The market has not been able to test lower prices during this period of time. Therefore, there's a nice safe location for our stop behind this range. And therefore, if this level breaks and we go higher, we now have a nice trend flow strategy with the bonus of a level. And on this higher time frame, if that's the high and that's the high, and you look out here, that's the high, that's the high, beautiful convergence, beautiful convergence, beautiful convergence out here. And out here, if we look back at the high and the most recent high, there's convergence out there too. I mean, here it's flat, but certainly here it's made a bit of a higher high. And as you go along the flat level here, as we mentioned, because there's mean reversion behavior, you see these things creeping back towards zero. It's staying near the zero line. But what it's done is shown us that price has been unwilling to push lower than a certain level. So there's some safety in the stop location. Does that make sense? Okay. Let's move on. Next example. Again, give you guys a minute to study this. Give me your answers. Good job, Maureen. Let me know if you see anything else out there that makes this interesting for you. Good job, Adrian. Good job, Nana. there are a couple of things out here that make this a little more attractive, and uh, see if you can spot what they are. Yep, you're right, Jose. So all of you are pointing out that this looks good for a trend flow short, and I agree with you. But there are a couple of things here that make it a little more attractive than normal. Okay, so let's discuss this. So again, price is trending on the setup chart and the higher time frames. The moving averages are correctly aligned and fanning. Price is in the buy zone on or sell zone on both time frames. There's a small bearish candle present. RSI is diverging on P but converging on P1. MACD is flat on P and converging on P1. So overall, 3 out of 4 is pretty good. There's no slap you in the face divergence here. There's no support or resistance obstacles that we can see. So this looks like a potentially good setup, right? But there's a couple more things here that are attractive, and I wanted you to start, getting sensitive to this. The first is that if you look at this, right, as your setup candle. By the way, this is not the most bearish candle. So in reality, you would not take this trade based on this candle because this is closer to indecisive than bearish. And what I'm relying on is this knowledge that, if you remember from our candlestick lecture, that if you had a series of bullish candles that are followed by indecisive candles where especially when the tops fail to make higher highs, that's a bearish indication. By itself, you would struggle to call this a bearish candle, right? But assume for now that this was a neatly bearish candle with like a taller tail. You would have to place your stop here, which is above the swing high, and you would place your entry at the break of this low, right? So one of the first things you notice is this is really tight risk, which means you can get like 1-to-1, 2-to-1, potentially 3-to-1 before the most recent low, and that is very attractive, right? Because it will be far more attractive than if your candle came down to here and you could just get 1-to-1 for your low. So one of the bonus factors, if you will, is the fact that because the candle is so small relative to the recent lows, there's a much greater potential risk to reward before you come to the first known area of resistance. So that's one of the bonuses that you should get good at picking out. The second thing is a little more subtle, and that's if you notice where you're going to enter if you break, right? It's going to be around this area. That's in line with this prior low, right? So if you break through that, then that's a confirmation that the market is happy getting below this swing low. Because this was the last time the market hung around here, and that makes it a kind of, even though it's being cut by this recent price action, the fact that it's again breaking through this resistance shows some conviction in the market's behalf that it wants to push lower. So again, right now on this example, it's not perfectly lined up, but when you see, scroll back and look at prior price action compared to where you're trying to go short or long. And if you see, the market has tested that level in the past, and on entering the trade, you're going to be pushed beyond that level. That's a kind of bonus factor because it shows conviction in the market's part. So yes. Okay. On here, again, we have the 8R, and this is, continuation of the prior example. So this is the P1 and P2, which is 2 and 4R. Here's 8R and daily, and we just see them confirming the downtrend. And looking at the higher time frames just shows you that this has been in progress for a very long period of time, long running trade, and therefore it's if you see a multi-day run again like you do on the right hand side here, it just gives you a chance to run for longer profits. Right now, initially, again, you're just going to take 1-to-1, but as you become one of those traders that lets part of their profits run for a while, this is the kind of option where, if you get in right and you let it run for multi-days, sometimes you can get 20-to-1 out of a trade. Now you have a half stake on that, so you still get 10-to-1 out of that portion, but all you need is 1 or 2 trades like that a year to make for a fantastic bank balance. Okay, practical 6. We just got one more after this and we're done with the practicals. Let me give you a chance to analyze this. Okay, I'd really like to see all your answers on this one. This is an interesting example. I'd love to see what you'd want to do and the reasons for why you're doing them. Good job, Nina. You're right. Yes, Adrian, that's one option. You're right, Maureen, but there's more reason for concern than just that. Look at one of the first items in your checklist. That's right. Okay, so first thing to notice is, you had an uptrend, you had a low, kind of high, kind of a higher low, or this is just a big push through, and this was the real early first high, low, high, lower low. Right now, you just lost the trend, right? You don't even have an uptrend. It's trying to reestablish into an uptrend. It hasn't actually made a higher high yet. It's made an equal high compared to the last position. And so right there, you don't have a higher high. So, if it had pushed convincingly higher like this and pulled down, then the fact that it made a bit of a lower low here, I might be able to overlook that. If it made, because you're going to have those in all trends, right? So it made a nice series of trends, made a momentary lower low, but pushed again high convincingly, broke the old highs, pulled back and was heading higher again. I'd I'd be open to overlooking this little bit of a lower low, but it made that lower low and then just made an equal high, right? Didn't even push higher. So right there is a sign that momentum is faltering. We see indicator divergences. All of you have pointed out, it's diverging here, diverging here, diverging here, arguably flat out here, but 3 out of 4 diverging, bad news. One thing that none of you pointed out, and start looking out for this stuff, big round number, right? Anything you do out here to get long is going to come smack up against a big round number. You're going to start seeing orders placed here, here, here. All around this big round number, you're going to see orders, right? Why do you think it resisted here? Why do you think it resisted here? The struggle to get through is because big round numbers are accumulating orders, right? And so the minute you see this big round number, it should have been a warning flag that, be wary of placing an order that's going to get your target very close to or on the other side of that big round number, right? So multiple factors out here. And sure, some of you pointed out the moving averages are intertwined. Another bad factor, you can't be trend flow trading when you've got spaghetti in your moving averages, right? So this is one of those reversal patterns. I mean, traditional chartists would call this like a double top. They'll see a top, the second top, they call this a double top. What we just call it is a trend running out of steam, right? And so this is not a tradable chart for either the two strategies we got today. Now, yes, it might be, as some of you have pointed out, that this pattern continues and we get another high, and then this ends up being a pause for a kind of momentum breakout strategy. It's possible the chart might play out that way, and you can watch it. You can put on your watch list for that. But right now, and by the way, that's a smart suggestion. Who made that suggestion? Adrian, yes, that was very astute observation, Adrian. That's exactly what I would have done. So if I saw this chart behavior, I'd say, okay, maybe this is setting out for a breakout strategy, and I'd put that on my watch list. But right now, no trade. Okay, let me just see. Yep, last example, and again, give you guys a minute. Love to see your answers. Okay, come on, guys. Last chance to participate in this 8-hour course. Give it your all. Good job, Nina. Good job, Maureen. Adrian, just look at your checklist. Work through the checklist. This isn't a flat level. I mean, look at it, right? Look at the variations in the candle heights. I mean, this is not coming anything close to a flat level. I mean, if you do a flat level, even if you ignored this peak and we're looking for a flat level here, you just have a single touch because these other things are not even close to a flat level. I mean, I can't draw a line horizontally very well, but you have, yeah, maybe one touch here, but these are all falling off. So you have one touch that's not even close to a flat level. The trend itself is, very iffy because you got a low. I mean, even if you look at the higher time frame, right? Say you have a low, a high, a higher low. You have a higher high, higher low, lower high, higher low. This is not a trend. So even on the higher time frame, you don't have a trend. You don't have a trend on this time frame. This is not promising. There's no clear trend. The chart is very spiky. Only one of you pointed out the spikiness on this chart, but look at either time frame, right? This is what you call a spiky chart. You got all these long wicks and tails all over this chart. This is just begging, especially when you're placing stops with the precision that either of these two strategies require. One big spike like this. So say you had a stop out here, or you had a stop below here. This big spike would take you out. Big spike would take you out. I mean, all along here, you're getting these big spikes that would take you out. So this is not a good chart structure to start with. Moving averages are crossing out here. They're already crossing down here. They're crossing down here. There's not a clear flat level. Let's look at the high time frames to see if they're any better. Yeah, on the higher time frames, like if you look at especially the weekly, by the way, there's the weekly and the daily here. If you look at the weekly, you see the chart is pushing up quite strongly, right? And so there is some overall upward momentum, and this is a chart worth watching. But this momentum has not given us a clean trend. And when I was doing my scan this morning for the week, I saw this in a couple of different charts where the charts themselves were just pushing up nicely. But when you look at the fine structure, there's no trend there. So yeah, you think like, boy, if I could find a way to ride this train, maybe I'd make some money. But there's no clear way to ride this train that minimizes my risk. I'm not seeing an underlying trend that's tradable, right? And I know that if I look at charts with this kind of behavior, even if I go down to a finer time frame, like a 15-minute chart, I'm not going to find, maybe there's a short-lived trend somewhere here on the 15-minute chart, but you don't know. There's no predictability about when that's going to happen. So overall, I look at this chart with sadness because there's all this movement and the fine structure is not tradable because it's not giving me a tradable trend. And also, by the way, the daily, even if you look at the daily as if you could find a chart on the daily is currently overextended. So more often, so looking at where the daily is compared to the daily's moving average, if we go back to this, any attempt to go along, even if you saw some kind of a flat level out here, would be highly risky because the daily is so overextended. My bet would be for a pullback rather than a breakthrough at this point, because a breakthrough would take you even further away from the averages. That's not the kind of bet I would want to make. So overall, not a good chart. This is the kind of chart you look at, especially the higher time frames. And the only reason I would have looked at these charts, by the way, is because I would have started off with my weekly and daily and said, the weekly seems to be pushing higher. Let me go down the time frames and see if I see any setups there that I might want to trade. Then I'd come back down and I'd look at these charts and say, yeah, there's no way I'm going to put money on that. And then I go look at some other chart. Okay, so much for the charts. Let's just move on to talk a little bit about risk management. So every time you place a trade, right, you're opening yourself up to the chance of risk. And what does that risk mean? It means you can lose money, right? And so we call this the account risk. And what we do is we control how much we're willing to risk on any one trade. You have a hypothesis in the market and you're paying a certain amount of money to see if that hypothesis is right. That's what you're doing, right? And you're really putting your money where your mouth is in the most practical way. And you're setting your stake or your position size based on the amount of capital you have in your account. And the 1% rule means, again, if you have a $10,000 account, 1% is $100, and you don't allow yourself to lose more than 1% on any trade. And of course, dollars or pounds or whatever is your native currency. So let's just get specific about how you do position sizing, right? It is, say your entry is out here, right? And it happens to be, say, 1.6745, and your stop loss is below down here, and that's 1.6695. Your entry minus your stop gives you 50 pips. That's your trade risk, right? And then you buy a big enough position so that a 50 pip loss loses you your 1%. Similarly, on this strategy, if you're using the trend flow strategy, same thing. You have an entry level, a stop loss level. Write down the two on a sheet of paper or in your computer, subtract, calculate the number of pips between your entry and your stop. That is your trade risk. And you calculate your trade risks based in pips, points, ticks, pennies, whatever is your is sensible for the market you're trading. If it's stocks, it would be pounds or dollars, right? And so how do you do position sizing? First, you find out your trade risk, right? So for example, that's your entry is, say, 1.6745. Your stop loss is 1.6695, and you have a 50 pip risk on that trade. Then if your account risk is $100, say 1% of 10,000, your trade risk is 50 pips, which is the subtraction of the two levels. Your position size then is $100 divided by 50 pips multiplied by 10,000, because you're doing this in 4 decimal places, and therefore you can buy a 20,000 unit position. So if you buy a 20,000 unit position and you get stopped out, you'll end up losing about 1% or $100, right? Now, sometimes you might lose a little bit more because of slip and stuff like that, but what you want to do is be in the ballpark that you wanted to be. Does this make sense? If there's any questions, ask me and we can go over this again, but this should be fairly straightforward to you by now. Trade management. Now, this is the question I think Adrian asked up front about how you manage your trades. My recommendation again is, when you're starting off, at least for your first couple of hundred trades, just take a simple 1-to-1. It's really, really tempting, especially when you take your profits at 1-to-1 and the thing runs 5-to-1, to think about all the regrets you have about not getting all that extra profit. But the number of times it can go against you is so many more than the times you're actually going to get that 5-to-1 runner. So just take 1-to-1 for your first 100 or 200 trades, settle down, get good at the strategies, get really good at reading what the market's trying to tell you, get good at noticing. This is the game of noticing, right? Noticing those numbers, noticing you're at a big round number, noticing what the moving averages are doing, noticing what subsequent candles are doing, noticing where their highs and lows are, noticing the size of the candles, the relationship to the zone, what the indicators are doing, or whatever other factors that you have in the strategies that you want to trade, right? It's noticing multiple things and making this kind of ensemble judgment about where things are more in your favor or more against you, and then placing the trade. That's so much to do and do well that just take the simple 1-to-1. It removes a big, huge variable out of the equation. And what that lets you do is just plan ahead of time that I'm going to enter the trade with this stop, symmetric target. Now I sit on my hands and let the market take care of the rest for me. And whatever answer comes back, you're happy with that answer because you executed well. Because if you fiddle with the trade and still make a profit, you should actually be unhappy, because what you've done is messed with the long-term probabilities by interfering with the trade. The only way those are going to work out for you is if you sit on your hands, let your strategy play out, and in the long term, make the money, right? So there needs to be sort of a minimum reward to risk on each strategy. We say take 1-to-1. Yes, it's possible to take less than 1-to-1 if you're winning at a very high rate. That's less likely. Therefore, we don't advise it or don't suggest it. You can do what you want, but don't try to go for, I wouldn't try to go for, a 50-cent profit for a $1 stake because I'm expecting to win 90% of the time. Yes, the math works out in your favor, but that's hard to do. And like I've pointed out to you a few times, the flip side's equally hard to do, which is, go for 3-1, but, accept a 40% win-loss ratio because you're losing much more often than you're winning. It's likely to cause you to do silly things, right? So in general, just risk $100 to make $100. Okay, so that is the webinar. Let us just do a quick summary here and what you've learned. We just try to say that technical analysis is like the ingredients in baking a chocolate cake. The strategy is like the recipe that tells you how to put together those instructions to make a successful cake. There's multiple technical ingredients at your disposal. We have covered a few out here in a way that we use them. This is not one of those courses where I tell you something and I do something different. I've pretty much told you everything that I do as a professional trader. I use these strategies in day in and day out. It's not like I'm using secret indicators that I'm not talking to you about. You can obviously, based on your own judgment and your own experience, layer in other factors that you think are going to tilt the probabilities in your favor. My one caution on that is more is not necessarily better, right? So you can go in and put in 20 factors in your trading checklist. Now, the problem with that is, as you have seen, trades are judgment calls, right? Even in the exercises we have done, you're going to have imperfect charts, you're going to have multiple factors. And when you have 20 factors, 30 factors you're looking at, the likelihood you're going to have all of them working at the same time is very low. So either you're one of the super disciplined people who's happy taking, one trade every 3 weeks, because that's the only time you're going to get all those factors lining up, or you're going to start making excuses. And when you start making excuses saying, yeah, this is not quite so perfect, but that's acceptable, this is not quite so perfect, that's acceptable, then what you have is an illusion of the checklist because you're constantly violating it because you're never getting a situation where all of them are met. So if you take a strategy, there is a kind of ideal point of the right number of factors that push probabilities in your favor. These strategies that we're sharing with you are the ones that we've refined over millions of trades. And I really mean millions of trades, because not only us and all the trades we take, but all the various people who have gone through trade with precision courses over the years have taken these trades and shared their results with us, and we've constantly refined them to be good strategies. They're well thought out with kind of the optimal number, in our opinion, of ingredients. So you might find that there's some ingredient that we don't watch that really works well for you, and you combine it in and you combine it successfully. More power to you. We hope that works out. But don't add 50 more ingredients because you think that's going to give you more assurance or more reliability, because like I said, they're all not going to kick in, and what you're trying to do at the end of the day is just over a large number of trades be right more than you're wrong. So we've shared 2 examples of strategies that utilize this approach. No matter what strategy you follow, risk and money management are vital components of any good trading plan and any good trading strategy. And what's next for you really is sit back, think about all these things we have done, revisit the material, have clean checklists, and then apply them to the markets, consistently, right? This is not something that's going to work if you give it 1 hour this week and 1 hour next week and then expect to make money. This is going to require dozens of hours of practice with the charts, getting good at applying these factors, and that's what's going to make you successful. By the way, a good way to get a reinforcement on all of this is to sign up for Oanda's market commentary videos. If those of you have not signed up, these are available on the YouTube and Facebook page of Oanda. Some of my colleagues or me give these, twice a week. They usually come out on Monday morning and Wednesday morning, New York time around 9 a.m. And they're a quick overview of the markets. And usually what we do is we go through all the charts that are interesting, pick out a few that we are watching with extra special interest. Like I did my weekly scan last night, and there were only about 5 or 6 charts that were particularly interesting at this point in time. Most of the markets are rangy and don't have great setups. And so what we do is we call those out for you in those charts, show what we're looking at, and it helps you, saves you time from having to scan 90 odd Forex markets. And we do Forex for Oanda because Oanda is primarily a Forex broker. And we also do gold and silver if those are showing up. But yeah, so look at these charts because we use all the techniques we talk about in forward thinking traders. We point out these things like moving average zones, candle size, pullbacks, RSI, MACD, areas of support resistance, where the charts are trending nicely, etc., etc., etc. Great way to see these principles being applied by somebody who is real familiar with them, and that reinforces your trading. We also have one of our webinars. It's called Forex in Focus. Go find it on the OANDA webinar list. That's a more interactive session, which is kind of a market commentary where we start off by pointing out charts of interest, but it's one of those situations where you can throw in the charts of interest to you and say, hey, I'm watching, GBP CHF, and here's what I think. Do you share this opinion? What's your opinion of your chart? And then the speaker will go through that chart using these techniques and analyzing them. So that's it for the webinar. Wish you all the very best as traders. We keep these market commentaries, we keep these webinars, these courses coming for now at OANDA. If you have any questions, review your videos, email us questions at frontdesk@oanda.com. We'd be happy to answer them for you, or I'd love to see you on another webinar or a refresh of these sessions. Okay, I'm going to pause and see if there's any questions, and if not, again, wish you all the very best as traders. If you stick with it, you can be successful. Don't for one moment assume it's going to be easy. There's not a magical level of knowledge after which suddenly trading becomes easy. Even where I am, it's a daily struggle. Markets are frustrating. They often do what you don't want them to do. You lose money. It's hard. But if you have faith in your skills and improving them, you can make money as a trader. Thank you, Kenneth. Thank you, Roberto. Thank you, Maureen. Let me see these questions coming in. Nina, you should get a link to this recording, within 24 hours. Usually it goes out midnight Canadian time or Toronto time, which is where OANDA's computers are situated. You're welcome, Adrian. So yeah, you should get a recording to this. If you don't get a recording, just shoot an email to frontdesk@oanda.com and say I didn't get a recording to the 4th session of Forward Thinking Traders, and somebody will take care of it immediately. You're saying Roberto has a question on slide 55. Let me just pull that up, Roberto. '55. Okay, let me read the question. Roberto, leverage, yes, leverage does figure into the calculation, right? In the sense that if you're trading a leveraged account, all it means is that, okay, let's do this. So first, this calculation you're doing here, so if this was the calculation you're doing and that was your entry, that was your stop, 50 pips was your trade risk, and 20,000 units is the position size you have to buy. The way leverage comes in is regarding the amount of margin you have to put up to take this position, right? The way foreign exchange brokers work is different from a stockbroker. A stockbroker, for example, if you have a $10,000 account and say Apple is trading at $500 a share, right? And if you have a $10,000 account, it'll say the most you can buy is 20 shares of Apple, because 20 times 500 is 10,000. That consumes your entire account, right? In the foreign exchange markets, what they do is you put down margin. Nothing actually leaves your account until the trade is closed. So say you take an account, right, and you buy a position that requires, say you have a $10,000 account, and you enter a position that requires a $1,000 margin, right? What that means is that the brokerage will escrow $1,000 off your $10,000, which means they put a hold on it, but it's not like that's money that leaves your account. You'll still see it in your account in the form of cash, but it's not tradable cash. If you try to place more orders, you can only place another $9,000 worth of orders. That $1,000 is held as margin in your account, and you can't use it for anything until the trade closes, right? Now what happens is the amount of margin that's held depends on the leverage you're using, right? So say you want to own a position that's worth $20,000, right? And you use no margin. That means you need to have $20,000 in your account in order to buy that position. But on the other hand, if you use a $20,000 position and you use 10-to-1 margin, it means that $2,000 of your account is going to get escrowed in order to own that position. Got it? Now if you say I want to be aggressive and utilize 50-to-1 margin, then what you're going to do is take your $20,000 and you're going to divide it by 50. You're going to cancel that out. You're going to say 5, and you're going to recognize that only $400 of your account is going to be locked up in margin, and that's going to leave $9,600 in your account to go place other trades, right? So the issue of leverage doesn't really affect the calculation of position size. It just affects how much of your account is being locked up in terms of margin. Now, if you're trading sensibly, right, and you have rules in your trading account as to the net exposure you're willing to take. So for example, in my trading rules, I don't take more net exposure at any point in time more than 5%, right? So I really don't care what leverage I'm using, right? So because if I'm using 5% of my account, it's so small that even when you scale up to the size of positions I need to buy, I'm actually using a fraction of my overall available capital that's actually locked up as margin. If I wanted, I could trade, enormous position sizes compared to my whole account, but I don't. So margin to me is more a tool that lets me amplify small moves in the market so I can capitalize on them. So they could be like a net move of 15 pips, and that could be a trade for me, whereas if I wasn't margined, there's not enough movement there to make it profitable. So what margin lets me do rather is exploit small moves in the market, but it really doesn't affect the total amount of trades I can take, because usually those are far in excess. What I can take is far in excess of what I actually take. Does that make sense? No, Roberto, percentage should never be linked to leverage. No, the percentage on any one trade should be linked to your account size, right? So say again, you have a $10,000 account size. On any one trade, you should not risk more than 1% of that account. So the position size you buy, right, on this particular example, should never exceed 20,000 units, regardless of your leverage, right? Because the 20,000 units is the size of the position that will cost you $100 if you get stopped out on this example. If you bought 40,000 units, then you'd lose $200, right? Margin is just saying, or leverage is just saying that, yeah, if you trade 50 to 1 margin on a $20,000 position, then it's only going to lock up $400 worth of your account in um, in margin. And so say you found 4 other trades like this. So say I was taking this trade, right, and I found 4 other similar trades that had the exact same parameters, so that each of which had a 20,000 unit stake on them. So if I took all 5 trades, then on each of the 5 trades I would lock up $400 worth of margin. So overall, across 5 trades, I've locked up $2,000 of my account. I still have $8,000 of my account to play with, but I won't play with it because my trading rule says do not expose more than 5% of your account at any one time. Now, you may have different trading rules, right? But my trading rules, because it prohibits me for taking more than 5% net exposure at any one time, even though 5 of these positions have locked up only 2,000 of my $10,000. That's where I stop trading. So now I sit on my hands and wait for these trades to close out before I take more trades. Does that make sense? So percentage is not linked to leverage. Percentage is predefined by you as the amount you're willing to risk on any one trade, and that should be 1% for now, or less. By the way, when I started trading, for the longest time, I was trading 0.1% stakes, right? So in this example, for a $10,000 account, I was not risking more than $10 a trade, because I wanted to make sure that my win-loss ratios, my risk-reward ratios, all my statistics were absolutely stable before I upped the amount of money I was willing to risk. So where you put the numbers up to you, but if you're starting off at 2%, 3%, 4%, you're just begging to have your account wiped out. 2%, what I'm saying is 1% is a good number for the long run, but initially you might actually start with a number that's way less than 1%, and that would be sensible. And the nice thing about Oanda, by the way, is Oanda lets you place, $1 trades or £1 trades. There's no minimum trade size. In the olden days, you had to place 100,000 unit trades. No longer true at Oanda. You can place trades of $1 on a fixed trade. Yes, Adrian. Adrian just pointing out that, history of Oanda trades can be found on the website in terms of spreads, and you can find those on the website. Yes. You're welcome, Dave. Thank you. Yes, it is.